You already know this feeling, even if you have never put words to it. The trade goes your way, just a little green flashes on the screen, your heart rate jumps, your palms get slightly sweaty, and suddenly you feel this urgent need to protect something that barely exists yet. So you close the trade quickly. You tell yourself you are being disciplined, smart, professional. You lock in that small win, and you feel a wave of relief wash over you. Then, hours later, sometimes minutes later, you watch price move exactly where you originally expected it to go, without you. Meanwhile, that losing trade you promised yourself you would cut fast somehow stays open, pulling back, going deeper against you. You widen the stop mentally. You delay the decision you hope. You wait. You negotiate with the market like it is a person who can hear you. And before you know it, one small loss has grown into something that wipes out several of those small wins you took earlier. This pattern is not random. This is not bad luck. This is your brain betraying you in real time. I have watched thousands of traders go through this exact cycle. Cutting winners in minutes, holding losers for hours. Same chart, same setup, same strategy. The only thing that changed was their emotional state. And that emotional state determined everything. Here is what nobody tells you. The reason you keep losing money is not your strategy. It is not your indicators. It is not your entry technique. The reason you keep losing money is that your brain is wired for survival, not trading. You are running software designed 200,000 years ago, and you are trying to use it in an environment it was never built for. The good news is this problem has a solution, not a motivational speech, not a mindset hack, a protocol, a systematic way to override the survival instincts that are draining your account one emotional decision at a time. Over the next 30 to 40 minutes, I am going to show you exactly why your brain sabotages your trades, how the 3 invisible enemies inside your mind control your exits, and the specific rules with specific numbers that will remove your weakest self from the decision-making process entirely. This is not about becoming fearless. It is about becoming structured. It is not about feeling confident. It is about executing correctly even when you feel uncertain. It is not about winning every trade. It is about behaving in a way that allows probability to work in your favor over hundreds of trades. By the end of this video, you will understand why patience is not passivity, but a weapon, why doing nothing is often the most profitable position you can hold, and why the traders who survive long enough to become profitable are not smarter or luckier than you. They simply learned to stop obeying their instincts. Let me describe a moment you have lived through more times than you can count. You enter a trade. Your analysis was solid. The setup looked clean. You had a target in mind. Then price starts moving in your favor. The position goes green, and something shifts inside you. Your heart beats a little faster. There is this tightness in your chest. Your eyes lock onto the profit number and you watch it tick up. $50, $75, $100. And with every tick, the voice in your head gets louder. Take it. Lock it in. Do not let this turn against you. So you close the trade. You bank that $100 and you feel smart, disciplined even. You protected what you had. You did not get greedy. Then you watch. And you keep watching. Because price keeps moving right past your original target. 200 points beyond where you exited, 300. You do the math in your head. That $100 win could have been a $500 win. You were right about everything. Direction, timing, level. But you are sitting there with a fraction of what the trade was worth. That is not discipline. That is fear wearing a mask. Now let me describe the other side of this pattern. You enter a trade. It goes against you immediately. Red on the screen. Your stomach tightens. But instead of the urgency you felt to close the winner, something different happens. You freeze. The voice in your head changes tone. It says give it room. It says the setup is still valid. It says the market is just shaking out weak hands before going your way. So you hold. The loss grows. -50 becomes -100. -100 becomes -200. You move your stop loss further away to give it space. You tell yourself you are being patient. But you are not being patient. You are avoiding pain. You are keeping the loss in a state of unrealized potential, because as long as you do not close it, your brain can pretend it is not real. It is not a loss yet. It is just a number on a screen. It could still come back. It does not come back. And that one trade wipes out 5 of those small wins you took earlier. Here is what you need to understand. The market did not change between those 2 trades. The chart did not change. Your strategy did not change. The only thing that changed was your emotional state. In the winning trade, you felt the need to protect. In the losing trade, you felt the need to hope. And both of those feelings led you to the same place, a smaller account. This asymmetry is not random. It is not a character flaw. It is biology. Your brain is doing exactly what it was designed to do. The problem is that what it was designed to do is completely wrong for trading. Jesse Livermore, one of the greatest traders in history, said it clearly. The speculator's chief enemies are always boring from within. He was not talking about the market. He was talking about your own mind. The first step in the survival override protocol is brutal awareness. You must see the pattern for what it is. Not as bad luck. Not as the market being manipulated, but as your own psychology working against you with perfect consistency. Once you see it clearly, you can start to understand why it happens. And that understanding begins with a trip back in time, about 200,000 years, to be exact. Here is a truth that will change how you see every trade you take. Human beings are wired to survive, not to trade. Your brain evolved in an environment where safety meant everything. Grabbing the sure thing kept you alive. Hesitating in the face of danger got you killed. For hundreds of thousands of years, this programming worked perfectly. See food, eat it now. See threat, run away immediately. Do not wait. Do not calculate probabilities. Do not think about the long-term distribution of outcomes. React. Survive. Live another day. Then, very recently in evolutionary terms, humans invented financial markets, and suddenly the rules reversed completely. In the wild, taking what you have and securing it immediately is smart. In trading, taking small profits early destroys your edge. In the wild, avoiding pain at all costs keeps you breathing. In trading, avoiding the pain of small losses leads to catastrophic large losses. In the wild, certainty equals safety. In trading, certainty does not exist, and the only place where profit lives is in the uncomfortable space of uncertainty. Your brain does not understand this reversal. It cannot understand it. The survival programming is too deep, too automatic, too fast. By the time your rational mind realizes what is happening, your emotional brain has already made the decision. This is why winning trades feel fragile to you. When price moves in your favor, your brain does not see potential. It sees something that can be taken away. And the moment something feels like it can be taken away, your survival instinct screams one thing: grab it now. Meanwhile, losing trades trigger the opposite response. When a trade goes against you, your brain does not feel immediate danger. It feels denial. As long as the loss is unrealized, it feels temporary, reversible, not quite real. Closing the loss would turn the pain from potential into permanent. So your brain chooses the option that feels safer in the moment. Delay. Rationalize. Hope. There is a concept in psychology called loss aversion. It means humans feel the pain of loss roughly twice as strongly as the pleasure of an equivalent gain. A $100 loss hurts more than a $100 win feels good. In trading, this creates a deadly asymmetry. You rush to secure gains because you fear losing them. You delay accepting losses because you fear the emotional impact of admitting you were wrong. The result is mathematically predictable. Small wins, big losses, a bleeding account. In the early 2000s, researchers conducted a study on retail traders. They tracked eye movement and stress responses during live trading sessions. What they found was counterintuitive. Stress levels were higher during winning trades than during losing ones. Why? Because during winning trades, traders feared losing what they had gained. They micromanaged every tick, terrified the green number would disappear. During losing trades, many entered a numbed state of denial. They looked away from the screen. They checked their phones. They dissociated from the pain. This is why you watch your winners like a hawk and ignore your losers. This is why you exit green trades after seconds and hold red trades for hours. You are not weak. You are not undisciplined. You are human. And being human means carrying 200,000 years of survival programming into an environment where that programming is precisely backwards. Understanding this is not an excuse to keep losing money. It is a responsibility to manage your biology. Because once you see what your brain is doing, you can start to catch it in the act. Every time you open a position, 3 invisible traders take the other side of your trade. They do not show up on your profit and loss statement. They do not appear on any chart, but they determine the outcome of nearly every decision you make. Their names are fear, greed, and ego. Let me introduce you to each one. Fear is the early closer. Fear is the voice that tells you taking profit now is smart and responsible. Fear is the whisper that says lock it in before the market takes it back. Fear sounds like wisdom, but it is actually cowardice dressed in reasonable language. Fear does not care about your expectancy. It does not understand that your edge requires letting winners run. Fear only cares about one thing: eliminating uncertainty. And the fastest way to eliminate uncertainty is to close the trade and walk away with something, anything, rather than nothing. The problem is that uncertainty is where profits live. The market does not pay you for comfort. It pays you for tolerating discomfort. Every time you close a winner early because you could not stand the anxiety of watching it fluctuate, fear wins and your account loses. Greed is the overleverager. Greed shows up after a winning streak. Greed is the voice that says you are hot right now, size up. Greed confuses recent results with skill. It looks at 3 winning trades and concludes that you have figured the market out. Bruce Kovner, one of the greatest traders of all time, said the worst thing that can happen to a new trader is to make money on their first trade. He understood greed. That early win teaches exactly the wrong lesson. It makes you think trading is easy. It makes you think you are special. It makes you increase size right before variance catches up with you. Greed turns normal drawdowns into account-destroying events. Because when you are oversized and wrong, the damage compounds faster than you can react. Ego is the loser holder. Ego is perhaps the most dangerous of the 3 because ego ties your self-worth to your trading results. When a trade goes against you, ego does not see a normal statistical outcome. Ego sees a personal attack. A losing trade challenges your identity. It suggests your analysis was wrong. It implies that maybe you are not as good as you thought. Closing that loss would mean admitting defeat. It would mean conceding that you made a mistake. Ego cannot tolerate this. So ego convinces you to hold. Keep the illusion alive. Give it more room. The setup is still valid. The market will prove you right eventually. Ego would rather lose money than lose face. These 3 do not announce themselves. They speak in disguises. When you close a winner early, you tell yourself profit is profit. You tell yourself nobody ever went broke taking gains. These phrases sound wise. They are fear talking. When you hold a loser past your stop, you tell yourself you are giving the trade room to breathe. You tell yourself patience is a virtue. These phrases sound disciplined. They are ego talking. The market does not care about your stories. It does not respond to your rationalizations. It only responds to probability and execution. Here is a truth that will be uncomfortable to hear. Your addiction to relief is more powerful than your desire for wealth. When a trade goes green, your brain experiences a specific chemical response. Uncertainty decreases. Anxiety drops. Relief floods your system. And relief feels good. Relief is the drug your brain craves when it is under stress. The problem is that you do not close winning trades to maximize profit. You close them to stop the anxiety of potentially losing them. You are not trading for financial gain. You are trading for emotional comfort. This is the relief trap. Think about what happens when price moves in your favor. Your brain does not calculate the optimal exit based on market structure. Your brain starts bargaining. It says, okay, we are up 50. That is good enough. It says, let us not get greedy. It says, imagine how bad it would feel if this turned into a loss. That last thought is the key. Imagine how bad it would feel. Your brain is not processing probability. It is processing imagined future pain. And to avoid that imagined pain, it tells you to exit now. Seneca, the Stoic philosopher, wrote that we suffer more often in imagination than in reality. He was talking about this exact phenomenon 2,000 years ago. The pain of watching a winner turn into a loser is often worse in anticipation than it would be in actuality. But your brain does not know the difference. It treats the imagined scenario as real and reacts accordingly. So you close the trade. You feel smart. You feel relieved. And then you watch price continue in your direction without you. I want you to remember a specific moment. A trade where you exited early, felt good about it, and then watched it run. You can probably feel it right now. The specific frustration of being right but not getting paid. The nausea of calculating what you left on the table. That feeling is the cost of the relief trap. Now consider the opposite scenario. A trade goes against you. Red appears on the screen. Your brain should tell you to cut the loss quickly. That is what your plan says. That is what you promised yourself you would do. But instead of urgency, you feel something else. You feel resistance. Because closing the loss would make the pain real. As long as the position is open, your brain can maintain the fantasy that it might still work out. Hope is the drug your brain sells you when a trade is going wrong. Hope says give it time. Hope says the market will come back. Hope says this is just temporary. Hope feels harmless. It feels like optimism. But in trading, hope is poison. Hope is the reason stops get moved. Hope is the reason small losses become large losses. Hope is the reason accounts bleed slowly instead of being protected decisively. The relief trap works in both directions. You close winners to escape the anxiety of uncertainty. You hold losers to escape the finality of being wrong. Both are emotional trades. Neither has anything to do with probability. One bad trade does not kill an account. What kills accounts is the sequence that follows. Loss leads to frustration. Frustration leads to revenge trade. Revenge trade leads to bigger loss. Bigger loss leads to desperation. Desperation leads to abandonment of every rule you ever set. I call this the revenge spiral. And once you are inside it, logic disappears completely. Let me walk you through how it happens. You enter a trade. Maybe it was not your best setup. Maybe you were a little bored and looking for action. The trade goes against you immediately. You hold, hoping it will recover. It does not. The loss grows. Finally you close it. You are frustrated. Angry at yourself. Angry at the market. Then something happens. Price starts moving in the direction you originally predicted. Now you feel something worse than frustration. You feel regret. Regret is the most dangerous emotion in trading. Because regret morphs into a need for redemption. You need to prove you were right. You need to get that money back. So you enter another trade. This time larger, to make up for what you lost. This trade fails too. Now the spiral is spinning faster. You are no longer trading your strategy. You are trading your emotions. Every click is an attempt to repair feelings, not to follow a plan. The loop feeds itself. Action, loss, emotion, reaction, bigger loss. This is not a market pattern. It is a human pattern. I have seen traders lose $500 on a bad trade and then lose $2,000 in the next hour trying to make it back. The first loss was unfortunate. Everything that came after was self-inflicted. There is also a phenomenon called time distortion that makes the spiral worse. When you are losing, time stretches. Every candle feels heavy. Every tick feels personal. Minutes feel like hours. You become hyper-focused on the pain and lose all perspective. The market has not changed. The same opportunities exist that existed before. But your perception has warped. You are not seeing the market anymore. You are seeing your own desperation reflected back at you. Most traders blow their accounts not because their strategy is terrible. They blow their accounts because they cannot survive drawdowns emotionally. A shallow drawdown is recoverable. You can take a break, reset your mind, and come back fresh. But once a shallow drawdown becomes a deep one through revenge trading, desperation takes over. And desperation destroys logic. The spiral has a starting point. And it is not the losing trade itself. It is the moment after the losing trade when you decide what to do next. That moment is where the survival override protocol becomes critical. Because in that moment, you have a choice. You can obey your instincts and chase redemption. Or you can follow a predetermined rule that removes your worst self from the equation. Here is something that will sound counterintuitive. You do not need a better algorithm. You need to stop acting like a toddler. A bad strategy executed with iron discipline will always outperform a genius strategy executed with emotion. This is not motivational talk. This is structural truth. Most traders spend years searching for the perfect system. They hop from indicator to indicator, mentor to mentor, course to course. They are convinced that profitability is hidden somewhere they have not looked yet. If they could just find that one missing piece, everything would fall into place. This is the holy grail fallacy, and it serves a very specific psychological purpose. It allows you to avoid looking at yourself, because if the problem is the strategy, then the solution is simple. Find a better one. But if the problem is you, then the solution is hard. Change who you are. Let me give you some numbers. A trader with a 40% win rate and strict discipline can become wealthy. They lose more often than they win, but their losses are small and their wins are large. Over hundreds of trades, the math works. A trader with an 80% win rate and no discipline goes bust. They win almost everything, but the few times they lose big. One bad week wipes out months of gains. Which trader would you rather be? Most people say the second one. They think winning 80% of the time sounds amazing. But the 80% win rate is meaningless if you cannot control the size of your losses. This is why discipline beats strategy every single time. Discipline allows the law of large numbers to work. It keeps your losses small enough that you can survive the inevitable losing streaks. It keeps you in the game long enough for your edge to manifest. Without discipline, you are constantly interrupting the math. You cut winners short, so your wins are smaller than they should be. You hold losers too long, so your losses are larger than they should be. Even a profitable strategy becomes a losing one when you trade it emotionally. Here is the key insight. Discipline is not willpower. Willpower fails under stress. Willpower is a finite resource that depletes throughout the day. Discipline is structure. It is environmental design. It is removing the option to behave stupidly. When you have clear rules, fixed risk parameters, defined sessions, and predetermined exits, you are not relying on your ability to make good decisions in the heat of the moment. You already made the decision in advance when you were calm and rational. The casino does not panic when a gambler wins a hand. The casino trusts the math over the month. It knows that any single outcome is irrelevant. What matters is the edge over thousands of repetitions. You need to become the casino, not the gambler. Amateurs trade outcomes. Professionals trade probabilities. This is the single most important distinction between traders who eventually make it and traders who blow account after account until they quit. When you judge your skill based on the result of one trade, you are committing statistical suicide. One trade tells you almost nothing about your edge. Even 10 trades barely matter. 100 trades begin to reveal patterns. 1,000 trades define performance. But you cannot think this way naturally. Your brain wants to attach meaning to every single result. When you win, you feel validated. When you lose, you feel like a failure. This emotional attachment to individual outcomes is precisely what prevents probability from working in your favor. The solution is a mental reframe so fundamental that it will feel unnatural at first. You must redefine success. Success is not did I make money. Success is did I execute the plan. If you followed your rules perfectly and the trade lost, that is a successful trade. You did everything right. The outcome was simply one of the losing outcomes that are baked into any probabilistic system. If you broke your rules and the trade won, that is a failed trade. You got lucky. And luck is not repeatable. Mark Douglas wrote that the market does not generate happy or painful information. It just generates information. The meaning you attach to that information is entirely your own creation, and the meaning you choose will determine your behavior. Think about losses differently. Think about them as operating costs. Every business has expenses. Rent, payroll, utilities. You do not cry when you pay the electric bill. You accept it as part of doing business. Losses in trading are the same. They are the cost of playing the game. They are the price of admission to the opportunities that produce profit. When you internalize this, something remarkable happens. The emotional weight of any single trade collapses. Winners stop feeling precious. Losses stop feeling threatening. They become what they actually are, data points. Imagine you are executing a robot's code. The robot has a strategy. You are simply clicking the buttons the robot tells you to click, 100 times, no deviation, no interpretation, no emotional response to individual results. After 100 trades, you evaluate the results. Did the strategy work? Should you adjust something? These are questions that can only be answered over a meaningful sample size. This is how professionals think. They do not care if they are up or down after 3 trades. They care about execution quality and statistical significance. I know what you are thinking. That sounds great in theory, but I am not a robot. I feel emotions. You are right. You are not a robot. And the goal is not to eliminate emotions. The goal is to stop obeying them. A consistent trader is not someone who feels nothing. A consistent trader is someone who feels everything and still executes correctly. That requires a skill most traders never develop: the ability to do nothing. Patience is not passivity. Patience is a weapon. The market transfers money from the active to the patient. It takes from the traders who need to be in a position, who cannot stand watching from the sidelines, who feel like they are missing out if they are not clicking buttons. It gives to the traders who can wait, who can sit through hours of nothing, who understand that most of trading is not trading at all. Warren Buffett said the stock market is a device for transferring money from the impatient to the patient. He was not talking about long-term investing. He was talking about psychology. Think about 2 different approaches. The first trader is like a rabbit, jittery, frantic, darting from one trade to the next. Every flicker of movement is an invitation to act. Every green candle is an opportunity. Every red candle is a threat. The rabbit exhausts energy chasing every tick. The second trader is like a lion, calm, watchful, conserving energy. The lion does not chase butterflies. The lion waits until the prey is close, injured, presenting a high probability opportunity. Then the lion moves once, decisively, precisely. The rabbit takes 20 trades a day and wonders why the account is not growing. The lion takes 2 trades a week and compounds steadily. Here is a truth that will be hard to accept. Cash is a position. Sitting on the sidelines is not missing out. It is preserving ammunition for a high probability target. Every dollar you do not lose to a mediocre trade is a dollar available for an excellent one. Fear of missing out is not ambition. It is insecurity. It is the fear that you are not good enough unless you are constantly active. It is the need for external validation through action. Real trading is boring. If you are excited, you are probably gambling. Professional traders spend most of their time doing nothing, watching, waiting, filtering out noise. The actual execution is a small fraction of the work. The waiting is where discipline manifests. Jesse Livermore, who made and lost several fortunes in the markets, put it simply: "It was never my thinking that made me money. It was always my sitting tight." Think about a sniper. The sniper spends hours, sometimes days, in position, watching, breathing, waiting. Then one shot, one perfect opportunity. That is all it takes. Contrast that with a machine gunner spraying bullets in every direction. More action, more noise, far less precision. Which one do you want to be? The survival override protocol treats patience not as a personality trait, but as a trainable skill. You can develop the ability to wait. You can strengthen your tolerance for stillness. You can reframe boredom not as a problem to be solved, but as proof that you are in control. Every hour spent not trading is an hour spent preserving capital, mental energy, and focus for when it actually matters. Now we have arrived at the core of this video. The specific rules that will change how you trade forever. You cannot eliminate the urges. They are biological. They are automatic. They have been running for longer than you have been alive. But you can stop obeying them. The survival override protocol is a set of 5 concrete rules with specific numbers. These rules remove your weakest self from the decision-making process. They create structure that makes emotional trading difficult. Rule 1. the 3 gates of action. Before any trade, 3 conditions must pass. First, is it in my plan? If the setup does not match your predefined strategy, the answer is no. No exceptions. No almost. No, this looks close enough. If it is not in the plan, you do not take the trade. Second, is the setup complete? Almost is not good enough. The market must confirm through price action, volume, or structure before you act. If you find yourself saying it is almost there, that means it is not there. Wait. Third, am I emotionally neutral? If you feel bored, frustrated, anxious, or desperate, step away from the screen. Emotional neutrality is the precondition for disciplined execution. If you cannot honestly say you are calm, you do not trade. All 3 gates must pass. If any one fails, you do nothing. Rule 2. The 24-hour loss rule. After any losing trade, you must wait 24 hours before trading again. Not 23 hours. Not after lunch. 24 hours minimum. This feels painful. Your brain will resist it. The urge to make the money back will be strong. That urge is exactly why this rule exists. Traders who implemented this single rule reported cutting their drawdowns in half. Not because their strategy improved. Because they stopped compounding emotional mistakes. Rule 3. The pre-acceptance ritual. Before entering any trade, say out loud the exact dollar amount you are risking. I am risking $200 on this trade. I accept this loss. If you cannot say those words and genuinely mean them, you are trading too big. The position size should feel almost boring. If losing the amount would change your behavior, would make you want a revenge trade, would keep you up at night, you are over-leveraged. Enter only positions where the worst-case scenario does not alter your emotional state. Rule 4. The 10-minute temptation timer. When you feel the urge to enter a trade early, when the setup is almost there, but not quite, set a timer for 10 minutes. During those 10 minutes, you are not allowed to act. You can only observe. What you will find is that most temptations fade before the alarm goes off. The urgency was artificial. The almost entry would have been a mistake. Over time, this exercise strengthens your ability to tolerate the gap between wanting to trade and actually trading. That gap is where discipline lives. Rule 5. The Profit and Loss Blackout. Stop watching your profit and loss in real time. Cover it. Minimize that part of the screen. Focus on price structure instead of the ticking dollar amount. Every tick becomes personal when you are watching money fluctuate. Every pullback feels like a threat. This emotional noise causes premature exits and stop widening. The money takes care of itself when you focus on execution. Trust the structure. Ignore the number. These 5 rules are not suggestions. They are the operating system of the survival override protocol. Each one addresses a specific failure mode. The 3 gates prevent impulsive entries. The 24-hour rule breaks the revenge spiral. Pre-acceptance ensures proper position sizing. The temptation timer strengthens patience. The blackout reduces emotional interference, but the rules only work in advance. Once you are inside a trade, you need a different kind of protocol. Once you are inside a trade, your intelligence quotient drops by 50 points. This is not an insult. This is neurological fact. The stress of having real money at risk activates your amygdala and suppresses your prefrontal cortex. The part of your brain responsible for calm, rational analysis gets overridden by the part responsible for survival responses. You are in the fog of war. And in the fog, you cannot trust your real-time judgment. This is why every decision about the trade must be made before you enter. Entry point, stop loss, target, position size, and exit conditions should all be predetermined. Written down. Non-negotiable. The moment you click buy or sell, your weakest self takes the steering wheel. The only defense is to have already locked in the destination. Let me give you a specific protocol for managing trades. First, accept that the market does not move in straight lines. There will be noise. There will be pullbacks. There will be moments where price moves against you before moving in your favor. This is normal. It does not mean you were wrong. You must let the trade breathe. If you set a stop loss at a certain level, that level should be based on market structure, not on how much money you are willing to lose. And once set, you do not move it closer. You either hit the target, hit the stop, or exit at a predefined time. No improvisation. Second, recognize the hope red flag. The moment you catch yourself saying "I hope it comes back," the trade is already dead. Hope is not a strategy. Hope is denial dressed in optimism. When hope appears, the correct action is immediate evaluation. Is your stop still in a logical place? Has the market structure changed? If the answer is yes, you exit. You do not wait for hope to be vindicated. Third, understand that cutting a loser is not admitting defeat. It is saving the ship. A small hole can be patched. A large hole sinks you. The ego wants to be right. The professional wants to be solvent. These are different goals. You must choose solvency over pride every single time. Fourth, do not add to losing positions. Ever. Averaging down is a strategy for investors with unlimited time horizons. For traders, it is a method of accelerating losses. When a trade goes against you, it is giving you information. The information is that your thesis was wrong, or your timing was wrong, or both. Adding more capital to a wrong thesis does not make it right. It makes the eventual loss larger. Let me show you what this looks like in practice. Imagine you enter a long trade. Price immediately drops 20 points. Your stop is 50 points away. Your brain starts screaming, "This is failing. Get out." Or worse, it starts bargaining. "Maybe I should add more here to lower my average." Neither response is correct. The correct response is nothing. You already made the decision when you entered. Your stop is where it is for a reason. The price has not hit your stop. Therefore, you sit. You wait. You let the trade breathe. Price drops another 10 points. Now you are down 30. The bargaining gets louder. But still, the stop has not been hit. You continue to wait. Then price reverses. It climbs back to your entry. It exceeds your entry. It hits your target. You did nothing during the entire trade except wait. And waiting was the most profitable action you could have taken. This is what combat protocols look like. Not heroic decisions in the heat of battle. Predetermined rules followed without deviation. Warren Buffett said rule number 1 is never lose money. Rule number 2 is never forget rule number 1. He was not saying you will never have losing trades. He was saying that protecting capital is more important than growing it. The damage is not done by the loss. The damage is done by the reaction to the loss. After a losing trade, your brain experiences a dopamine crash. You were expecting a certain outcome. You did not get it. The chemical response is immediate: discomfort, agitation, a craving to restore balance. Your brain wants a win. Not because a win is the smart move. Because a win will release the dopamine you are now missing. You are not thinking about probability. You are thinking about making the uncomfortable feeling go away. This is where revenge trading comes from. The desperate need to fix the chemical imbalance in your brain by forcing a win. The revenge spiral claims more accounts than bad strategies ever will. A trader loses $500. They feel the crash. They enter another trade, larger this time, trying to make it back quickly. They lose again. Now they are down 1,000. The desperation intensifies. They take another trade, even larger. Within an hour, they have turned a manageable loss into a catastrophic one. The antidote is the reset protocol, a hard circuit breaker that prevents emotional spiraling. When you experience a significant loss, significant being whatever amount affects your emotional state, you stop trading. Not for an hour. Not until you feel better. For 24 hours minimum. During that time, you do not watch the charts. You do not check what would have happened if you had held. You step away completely. You take a walk. You do something unrelated to trading. You let your nervous system calm down. This feels painful. Your brain will scream that you are missing opportunities, that the market is moving without you, that you need to make back what you lost. That scream is exactly the voice you need to ignore, because that voice is not logic. That voice is addiction. The second component of the reset protocol is rebuilding trust. Not trust in the market. Trust in yourself. After a significant loss, especially if you broke your own rules, you do not immediately go back to normal trading. You reduce your size. You take only the most conservative setups. You prove to yourself that you can follow the rules again. This is how self-trust is rebuilt. Not through positive self-talk, through demonstrated evidence. Each time you follow your rules, even when it is hard, You send a signal to your brain that you are reliable. Over time, that signal becomes belief. The trader who loses 500, takes a 24-hour break, and comes back at reduced size will recover. The trader who loses 500 and immediately tries to make it back will likely lose more. The market will be there tomorrow. The opportunities will not disappear. The only thing that can disappear is your account. Protect it above all else. Your behavior in trades is a mirror of how you handle discomfort in life. When something feels good, you rush to lock it in. When something feels bad, you delay dealing with it. You procrastinate on difficult conversations. You avoid acknowledging problems until they become crises. You grab short-term pleasure at the expense of long-term benefit. Trading simply exposes this pattern with brutal, unforgiving clarity. The market does not let you hide from yourself. Every weakness, every avoidance, every fear shows up in your equity curve. This is why trading is so hard. It is not just a financial endeavor. It is a psychological one. You are not only trying to make money. You are trying to overcome decades of conditioned responses. The same psychology that makes people hold losing trades makes them hold toxic relationships. The longer something is open, the harder it becomes to walk away. You have invested time, energy, emotion. Closing the position feels like wasted effort. The breakthrough comes when you stop attaching your identity to trade outcomes. When a loss becomes information instead of a verdict. When it stops saying something about your intelligence or worth and simply says this outcome did not work this time. When losses lose their emotional charge, you stop avoiding them. You close them cleanly, without hesitation. When you trust your system, you stop fearing giving profits back. You know some winners will retrace. You do not interfere because interfering damages the edge. This is the transformation the survival override protocol creates. Not a new strategy, a new identity. You must kill the part of you that wants to be a hero. The part that wants to catch the exact bottom. The part that wants to call the top. The part that wants to size up huge on a conviction play and brag about it later. The hero does not survive in trading. The hero goes broke in spectacular fashion while everyone watches. The survivor is boring. The survivor takes normal-sized positions. The survivor follows rules that are not exciting. The survivor sits on their hands when there is nothing to do. Stop trying to win. Start trying to execute correctly. Discipline comes first. Confidence comes later. Profits come last. Trying to reverse this order leads to endless frustration. If you want excitement, go to Vegas. Go skydiving. Go do something where the adrenaline serves a purpose. If you want rent money, learn to sit on your hands. The real trading happens in the invisible work. The journaling, the trade review, the waiting. Nobody sees these things. Nobody applauds them. But they are where edge is built and protected. Here is the final test. Can you sit in front of the screen for 4 hours, see nothing, do nothing, and call it a perfect day? If the answer is yes, you have arrived. You have killed the hero. You have become the operator. Marcus Aurelius wrote, "You have power over your mind, not outside events." Realize this and you will find strength. Trading teaches this lesson every single day. You do not control the market. You do not control price. You do not control whether this specific trade wins or loses. What you control is your reaction, your execution, your adherence to rules. When you master that, the outcomes take care of themselves. When the market goes silent, when nothing moves, when the candles freeze and doubt creeps in, that is the real test. Most traders panic in the quiet. They mistake stillness for failure. They force trades just to feel like they are doing something. They cannot tolerate the gap between wanting to act and having nothing to act on. But the few who wait know the truth. Silence is where mastery is forged. Every second you resist the urge to act, you grow stronger. Every moment you trust your discipline instead of your impulse, you sharpen your edge. The market does not reward the restless, it rewards the patient. The test is always the same every day. Every session. Every trade that appears on the screen. Will you obey your instincts or your process? The answer you give, trade after trade, week after week, is your trading career. Not what you know. Not what strategy you use. The answer to that single question determines everything. In a world addicted to immediacy, patience is nearly extinct. Everyone wants results now. Everyone wants to feel like they are making progress. The market feeds on this restlessness. It thrives on the mistakes of the impulsive. Your patience is a rebellion against the crowd. Your stillness is a weapon they cannot match. At the beginning of this video, I described a feeling you know too well. The green flashing on the screen. The heart rate jumping. The urgent need to protect something that barely exists. That feeling will not disappear. It is biological. It is automatic. It has been running since before you were born. But now you understand it. Now you can name it. Now you have a protocol to override it. The market will test you tomorrow. It tested you today. It will test you every day you choose to participate. The question is always the same. Will you wait, answer correctly, and everything changes?